Most people chase money their whole lives and never realize they've been solving the wrong equation. There are only 4 variables standing between you and real wealth. Let's break them down. The 4-variable wealth formula. Most people think wealth is complicated. They imagine it requires a finance degree, a lucky break, or a rich family. But when you strip away the noise, the hot stock tips, the get-rich-quick schemes, the conflicting advice, wealth creation comes down to just 4 variables. Master these 4, and financial independence becomes not a dream but a mathematical certainty. Let's break each one down. Variable 1. Income, the raw material. Income is the foundation. Without it, the other variables have nothing to work with. But here's what most people misunderstand. Income is not fixed. It is not determined by your degree, your background, or the job market. Income is a skill. It can be learned, practiced, and grown. The first step is to stop trading time for money at a fixed rate and start thinking about how to increase your value in the marketplace. This means developing rare and useful skills, skills that solve expensive problems for individuals, businesses, or institutions. The higher the cost of the problem you solve, the higher your earning potential. There are 3 primary ways to grow income. The first is career advancement, getting promotions, switching to higher-paying industries, or negotiating aggressively. Many people leave enormous amounts of money on the table simply by never asking for a raise. Studies consistently show that switching jobs produces faster income growth than staying loyal to a single employer. The second is building a side income. In today's economy, a second stream of income is no longer a luxury, it is a hedge against instability. Freelancing, consulting, creating digital products, or building a small service business can add meaningful income without requiring a career change. The third is building scalable income, income that doesn't require you to show up every hour to earn it. This includes royalties, licensing, rental income, and digital products. Scalable income is the bridge between earning and investing. Income is the raw material of wealth. More of it, deployed wisely, accelerates everything that follows. Variable 2. Savings rate. The engine. If income is the raw material, savings rate is the engine. This is the percentage of your income that you keep, invest, and put to work. And it is arguably the single most powerful variable in the entire formula, because it is almost entirely within your control. Here is a truth that surprises most people. Your savings rate matters more than your income. A person earning $50,000 a year and saving 40% will build more wealth over time than a person earning $150,000 a year and saving 5%. The math is unforgiving. The conventional wisdom says to save 10 to 15% of your income. But conventional wisdom produces conventional results. High net worth individuals and early retirees often save 30%, 40%, even 50% or more of their income, not because they earn extraordinary amounts, but because they are intentional about the gap between what they earn and what they spend. The enemy of savings rate is lifestyle inflation, the tendency to upgrade your life every time your income rises. A raise becomes a nicer car. A bonus becomes a vacation. Overtime becomes a bigger apartment. This is the silent wealth killer. The antidote is to live on last year's income while investing this year's raise. Every time your income grows, funnel the increase directly into investments before your lifestyle has a chance to absorb it. Savings rate is not about deprivation. It is about prioritization. You are not denying yourself pleasure, you are choosing future freedom over present convenience. Variable 3. Return on investment, the multiplier. Once you have saved money, you need to put it to work. This is where return on investment, ROI, comes in. ROI is the rate at which your money grows. And thanks to the power of compounding, even small differences in ROI can produce massive differences in long-term wealth. Consider this. $100,000 invested at 6% annually grows to $574,000 over 30 years. At 9%, it grows to $1,327,000. That single difference in ROI, just 3 percentage points, produces more than double the wealth. This is the multiplier at work. The foundation of a strong investment return is a diversified portfolio of productive assets. For most people, low-cost index funds that track the broad market are the simplest, most reliable path to strong long-term returns. They require no expertise, charge minimal fees, and historically deliver returns in the range of 8 to 10% annually over long periods. Return on investment is the multiplier in the wealth formula. Optimize it and time does the heavy lifting for you. Variable 4. Time. The great amplifier of all 4 variables, time is the one most people waste. And unlike the others, you cannot earn it back. Time is the great amplifier, the variable that turns modest savings and ordinary returns into extraordinary wealth. The principle is simple. Money invested early grows exponentially. A dollar invested at age 25 is worth many times more than a dollar invested at age 45, not because the markets are kinder to young people, but because compounding needs time to build momentum. In the early years, growth seems slow. In the later years, it accelerates dramatically, and the vast majority of your wealth is created in that final phase. Time also works in reverse. Debt with interest is compounding working against you. High-interest debt is the mirror image of high ROI investing, except the returns flow to the lender, not to you. Eliminating bad debt is mathematically equivalent to earning a guaranteed return equal to the interest rate. The message is clear: start now. Not when you earn more. Not when the market looks right. Not when your situation is more stable. Now. Even small amounts invested early will outperform large amounts invested late. Start today. The formula is waiting. Now you have the formula, the only question is which variable you're going to move first. Drop it in the comments, and if this hit different, share it with someone still doing the math the hard way.